Dan Ives, the global head of tech research at Wedbush Securities, just dropped a bold prediction on CNBC's Fast Money. According to him, Wall Street is massively underestimating AI-driven growth. In this video, I'll show you the exact clip of what Dan Ives said, and then break it all down for you. I'll share my honest reaction, dig into what it means for investors, and give you 3 high-potential growth stocks that I believe are worth buying right now. If there's one video you watch today, make it this one. Especially if you're serious about staying ahead of the curve in tech investing. Smash that like button. Let's hit 1,000 likes on this video. Share the video and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's hear exactly what Dan Ives had to say.
Dan Ives, the firm's global head of technology research, is behind the call. His research is behind the Dan Ives Wedbush AI Revolution ETF, which was launched last month. Dan, it's so great to have you here, especially ahead of earnings season. What do you expect from these big names? And I know there's one name you think everybody should be in. You can get in now. You're not too late.
Yeah, I mean, Courtney, I think this is going to be a very bullish tech earnings season. I think that the main thing is that we're seeing the use cases when it comes to AI exploding. And that's bullish for software and the hyperscalers, led by, of course, Redmond and Nadella, in terms of everything that Microsoft, I think that's one, not just $4 trillion. We think that could be a $5 trillion market cap along with NVIDIA in the next 18 months. But this is going to be, I think, really a prove-it time for tech. I think they're not going to disappoint. And I think second half, tech stocks are up another 12 to 15%.
Hey, Dan, you know, the main names that you always cover that you've been bullish and you've been right on are really interesting. What's more interesting to me is the software coverage that you have. Tell me a little bit about the catch up, if you think we're going to see some of these names catch up to the leaders that we've seen in the software space.
Yeah, Grasso, great question. To me, that really is going to be a huge narrative in terms of on the software trade and earnings season. Because software has underperformed. I mean, if you think about it. But now, it's not just Palantir, which obviously is our top one in terms of AI revolution. MongoDB, Snowflake. You know, I think IBM is seeing a massive renaissance of growth when it comes to what we're seeing on AI monetization. The use cases are exploding. And that's why I think software and even cybersecurity is going to be what I believe could be a significant outperformer across all of tech second half of the year.
So, Dan, I think Microsoft made an all-time high today, 3.8 trillion-ish, so another 1.2 to go. They're going to do about 340 billion dollars in revenue next year. What does that revenue number need to be to justify a $5 trillion company?
Yeah, it's a great question, Guy. To me, it's really about Azure revenue that's accelerating. I think we can now see acceleration 200, 300, 400 bips over the next, call it 6 to 12 months. But I think the main thing is, when you think about AI and the stack as a percent of overall revenue, it's small today. But I think as we go into next year, that could be 15, 20%. You think about the math on that, I think Street's underestimating numbers here by potentially 10, 15%. That's why, in my opinion, $4 trillion is just a stop. I believe this is one. 600 is our base case price target. Bull case could be $700 to get out the popcorn moment, I think, as we go into earnings season for Nadella and Redmond.
Dan, it's Tim. People were throwing popcorn on the floor today at ASML. How do you explain the guide there? And again, they would be more emblematic of the infrastructure around tech and obviously the picks and shovels. And it was an awful guide.
Yeah, it was. And look, and obviously, Tim, I think this is going to be a little uneven as this all plays out. But I like when I look at ASML, like that's when I'd actually be a buyer on this type of sort of reaction. I think overall semis, in terms of everything that we see over the next, call it 3-6 months, is going to have a massive move higher. Because right now, demand to supply is still 10 to 1 when it comes to AI and it comes to chips from NVIDIA. That's all from our checks in Taiwan. And that's why we believe any of these sell-offs, they should be bought.
Dan, it's Karen. Thanks for being on. So you've said we're in the second inning of this AI revolution. We know that stocks peak before the end of the revolution. What inning do you think stocks peak in?
Yeah, look, I think stocks could peak, maybe in sixth, seventh inning. But that means that we're going to basically have this run through, I think, not just the end of this year, but through most part of next year, because you're still seeing so many enterprises. Only 4% enterprises have spent on AI in the U.S. So I think this is a CapEx explosion. It's a fourth industrial revolution. We've talked about it. The AI party, it was 9 p.m. It's now 10 p.m. and it goes to 4 a.m. And that's why I believe you buy these stocks. And I think 2Q is going to be, I think, the start of what is ultimately a golden age for tech stocks.
So if you're watching this wondering whether you're too late to the AI investment wave, or if it's time to start trimming your tech exposure, you're going to want to hear this. Let's get into it. So first things first, Dan Ives comes right out of the gate doubling down on his bullish stance toward artificial intelligence. He doesn't just think AI is a trend, he's framing it as a secular growth driver that's about to lead tech into another multi-year rally. And not just in a vague way, he's backing it with capital too. He recently launched the Wedbush AI Revolution ETF, a fund built specifically around the companies he believes will dominate this next chapter. Now the key theme that stood out to me from this interview is this idea that we're still early, very early in this AI boom. He calls it the second inning of the revolution. So if you're someone sitting on the sidelines thinking you missed NVIDIA or Microsoft or Palantir, Dan's message is clear, you haven't. In fact, he says this earnings season is going to be a prove-it moment for tech, and he's confident the sector won't disappoint. And let's unpack why. He mentions that the use cases for AI are now exploding, and that's not just hype. That translates to real scalable revenue potential, particularly in software and cloud infrastructure. He specifically names Microsoft as a massive benefactor here. He says we could see Microsoft's market cap rise from $4 trillion to $5 trillion within the next 18 months, riding this AI wave. Mostly through the growth of Azure, their cloud computing platform. Now that's an important point. Because he's not just talking about AI in theory, he's talking about monetization. He expects the portion of Microsoft's revenue tied to AI to go from a relatively small percentage right now to as much as 15-20% next year. That's a significant shift, and it suggests the street might be underestimating just how impactful AI will be to top-line growth. Dan even says the market may be lowballing earnings estimates by 10-15%, especially when it comes to the big AI leaders like Microsoft and NVIDIA. That's why he believes $600 or even $700 price targets for Microsoft are not outrageous. He actually uses the phrase popcorn moment, meaning this upcoming earnings season could be one of those game-changing inflection points where the bullish thesis becomes undeniably clear to the broader market. Now, he doesn't stop there. The conversation moves into software. And this is where things get interesting. He points out that software stocks have underperformed relative to the big names like NVIDIA and Microsoft. But according to him, that lag is temporary. He sees a catch-up trade happening in the second half of this year, driven by companies that are rapidly starting to monetize AI. He names Palantir as his top AI software play, and then also calls out MongoDB, Snowflake, and IBM. And his reasoning is simple. These are companies that are already integrated into enterprise workflows. They're not just talking about AI, they're building it into the backbone of how businesses operate. And investors are going to wake up to that. Another area Dan's bullish on is cybersecurity. He sees it as a key beneficiary of AI adoption, especially as enterprises scale up their digital infrastructure. That sector has lagged behind in 2024, but he believes it's about to outperform the broader tech sector in the second half. Now there was also a really interesting exchange around ASML, the Dutch semiconductor equipment giant. Their recent earnings guidance was weak, and the stock got hit, but Dan brushes it off as a buying opportunity. He essentially says, don't overreact to short-term volatility in these picks and shovels names, because demand for AI chips, especially from NVIDIA, is still outpacing supply 10-1. That's a stunning ratio, and it suggests there's a lot more upside left in the semiconductor supply chain, even for the less flashy names. Finally, they get to the big picture stuff. Dan uses a baseball analogy to frame where we are in the AI cycle, saying we're in the second inning of a game that will run well past midnight. He jokingly compares it to a party that started at 9 p.m., is now at 10 p.m., and will go until 4 a.m. In other words, we've only seen the beginning of the capital expenditure cycle. Only 4% of U.S. enterprises have deployed serious AI spending. That's a number that could explode in the coming quarters. So what does this all mean for investors? It means the AI boom is far from priced in. It means that some of the biggest opportunities may actually be in the second-tier stocks, in software, cybersecurity, and the semiconductor ecosystem. And it means that even the giants like Microsoft, which are already trading at multi-trillion-dollar valuations, still have significant room to run if AI spending ramps as expected. So that's my breakdown of Dan Ives' interview. He's not just calling for a bullish tech market, he's laying out a specific roadmap for where the value could flow next: software, cloud, AI infrastructure, and beyond. Let me know in the comments what you think. Do you agree with Dan that we're only in the second inning? Or do you think this market is already starting to top out? I'd love to hear your thoughts. If you found this analysis helpful, make sure to hit that like button, share the video with a fellow investor, and of course, subscribe for more deep dive reactions and financial breakdowns like this one. We've got a lot more coming. Our first pick is Alibaba, ticker BABA. Once the undisputed titan of Chinese e-commerce, Alibaba has faced a turbulent few years. But beneath the surface, this company is quietly setting the stage for a remarkable comeback that savvy investors won't want to miss. Yes, it's been beaten down by regulatory crackdowns and fierce competition, with headlines painting a picture of doom and gloom, but that's exactly where the opportunity lies. When sentiment is at its lowest, that's often when the seeds of the next bull run are planted. Alibaba still dominates e-commerce in China, serving nearly 1 billion people through its flagship platforms like Taobao and Tmall. These platforms are deeply woven into the daily lives of Chinese consumers, handling everything from groceries to luxury goods, and their reach is only expanding as digital adoption accelerates across the country. Its core business remains a cash machine, generating billions in free cash flow every year. This financial strength allows Alibaba to invest aggressively in new ventures, fund innovation, and weather economic storms better than most competitors. The real gem, though, is Alibaba Cloud, Asia's answer to AWS. It's not just leading the region's cloud market, it's also expanding into new verticals like AI, fintech, and enterprise solutions. Alibaba Cloud is growing at a double-digit pace, and as more businesses digitize, its potential is enormous. Despite these strengths, the market is ignoring Alibaba's fundamentals, pricing the stock at a single-digit forward PE, almost unheard of for a global tech leader. This disconnect between price and value is what makes Alibaba so compelling right now. Regulatory pressures are finally easing, with the Chinese government signaling a more supportive stance toward tech innovation. Meanwhile, Alibaba is restructuring into 6 agile business units, each with the autonomy to unlock hidden value and pursue growth independently. This move could unleash a wave of innovation and efficiency across the company. Analysts are taking notice, with many projecting 50% or more upside for the stock. Some even believe Alibaba could double or triple in value as the restructuring and cloud growth story unfolds. The consensus is clear: Alibaba is deeply undervalued relative to its long-term prospects. Of course, risks remain, mainly geopolitics and the potential for renewed regulation, but much of that risk is already baked into the current share price. The market's pessimism has created a margin of safety for those willing to look beyond the headlines. Meanwhile, Alibaba is aggressively buying back its own shares, signaling strong confidence from management. These buybacks not only support the stock price but also increase the value of each remaining share, rewarding long-term investors. The company is also investing heavily in artificial intelligence, integrating cutting-edge AI across its e-commerce, logistics, and cloud businesses. This commitment to innovation ensures Alibaba stays ahead of the curve, adapting to new trends and consumer behaviors faster than its rivals. Don't overlook Cainiao, Alibaba's logistics arm. It's a global powerhouse, using smart technology and automation to deliver packages faster and more efficiently than ever. As cross-border e-commerce grows, Cainiao's value as a logistics innovator will only increase. Institutional investors are quietly accumulating shares, seeing past the short-term noise and betting on Alibaba's long-term transformation. When the big money moves in, it's often a sign that a turnaround is underway. In summary, you have a dirt-cheap valuation, stabilizing regulation, a value-unlocking restructuring, e-commerce dominance, cloud leadership, and massive buybacks. All in one package. Few companies offer this combination of growth, value, and resilience. This isn't a get-rich-quick scheme. It's a calculated bet on a world-class company at a historic discount. It's about patience, discipline, and recognizing value where others see only risk. For patient investors, Alibaba could be a portfolio game-changer by 2025. The potential for outsized returns is real, especially as the company's transformation gains traction and market sentiment shifts. The market's thrown out the baby with the bathwater. Will you seize the opportunity, or let fear and headlines keep you on the sidelines while others build wealth? If you want to build real wealth, sometimes you have to be contrarian. The greatest investors, think Warren Buffett, have always made their biggest gains by buying when others are fearful. Alibaba's fundamentals are strong, and the catalysts are lining up. The company is positioned to benefit from both domestic recovery and global digital trends. Don't let fear keep you from one of the decade's best opportunities. Sometimes, the best investments are the ones that feel the most uncomfortable at first. Next up, a hidden gem powering the digital future. Stay tuned, because because the next opportunity could be even bigger. Our second pick is for those seeking explosive growth in digital assets, without the wild swings of buying coins directly. If you've ever felt the FOMO of missing out on the last crypto bull run, but hesitated because of the stomach-churning volatility, this opportunity could be your answer. Instead of riding the roller coaster of individual tokens, imagine owning a stake in the very infrastructure that powers the entire digital asset ecosystem. This is about investing in the picks and shovels of the digital gold rush, not just the gold itself. Meet 𝗣𝗟𝗏 Technologies, ticker BTDR, a pioneer in crypto mining and high-performance computing. 𝗣𝗟𝗏 is not just a name in the background, it's a driving force shaping the future of blockchain infrastructure. With a global presence and a relentless focus on innovation, 𝗣𝗼𝗏 is quietly building the backbone of tomorrow's digital economy. 𝗣𝗼𝗏 isn't just another miner, it operates on three fronts: self-mining, cloud hashrate, letting customers rent mining power, and hosting services for third-party miners. This multi-pronged approach means 𝗣𝗼𝗏 isn't dependent on a single revenue stream. Whether Bitcoin is surging or consolidating, 𝗣𝗼𝗏's business model is designed to capture value across the entire crypto mining value chain. This diversified model creates steady, recurring revenue and cushions volatility. By offering cloud hashrate and hosting, 𝗣𝗼𝗏 locks in long-term contracts and predictable cash flows, even when crypto prices are choppy. It's a business built for resilience, not just hype. The recent Bitcoin halving is a huge catalyst. Historically, it triggers bull runs and squeezes out inefficient miners. Every 4 years, the halving event cuts the reward for mining new Bitcoin in half, making it harder for less efficient players to survive. This creates a natural selection effect where only the strongest, most innovative miners thrive. 𝗣𝗼𝗏, with its scale and technology, is perfectly positioned to benefit from this shakeout. 𝗣𝗼𝗏, with its low costs and proprietary tech, stands to gain market share and expand margins. Their SealMiner rigs and advanced cooling systems give them a significant edge, allowing them to mine profitably, even when others are forced to shut down. As weaker competitors exit, 𝗣𝗼𝗏 can scoop up more of the network's rewards, driving both revenue and profitability higher. But the real game-changer? 𝗣𝗼𝗏 is pivoting into AI cloud services, leveraging its data centers for the exploding demand in AI computing. The same infrastructure that powers crypto mining can be repurposed for artificial intelligence workloads. Think machine learning, big data analytics, and more. This is a massive, fast-growing market, and 𝗣𝗼𝗏 is already making strategic moves to capture it. The market still values BTDR as just a miner, ignoring its AI potential, a setup for a major re-rating as new revenue streams kick in. As investors wake up to the company's transformation, there's a real chance for the stock to be revalued as a tech growth story, not just a cyclical mining play. This disconnect between perception and reality is where outsized returns are born. Analysts are bullish, with some price targets suggesting the stock could double or triple as these catalysts play out. Wall Street is starting to take notice, and as more institutional investors dig into the numbers, the upside could accelerate. The combination of post-halving momentum and AI-driven growth is rare and powerful. The risk? Bitcoin's price volatility. But 𝗣𝗼𝗏's diversified business and global footprint, spanning the US, Norway, and Bhutan, provide resilience. By operating in multiple jurisdictions and currencies, 𝗣𝗼𝗏 can adapt to regulatory changes and market shocks. Its international reach also means access to cheap renewable energy, further lowering costs and boosting sustainability. The founder Jihan Wu is a crypto industry legend, adding credibility and vision. Wu's track record as the co-founder of Bitmain, one of the world's largest mining hardware companies, gives 𝗣𝗼𝗏 a leadership edge. His deep connections and strategic foresight are invaluable assets as the company navigates both crypto and AI frontiers. As institutional money flows into digital assets, demand for secure, reliable mining and hosting will surge, and 𝗣𝗼𝗏 is perfectly positioned. Pension funds, endowments, and hedge funds are all looking for exposure to digital infrastructure, but they need partners they can trust. 𝗣𝗏𝗏's reputation for security, transparency, and operational excellence makes it a top choice. In summary, post-halving tailwinds, a best-in-class operator, a pivot to AI, and a world-class team. 𝗣𝗼𝗏 is not just riding the wave, it's building the surfboard. The company's ability to innovate and adapt sets it apart from the pack, and its leadership is laser-focused on long-term value creation. BTDR offers asymmetric upside, crypto excitement plus real tech growth. For those who want exposure to both the digital asset revolution and the AI boom, 𝗣𝗼𝗏 is a rare find. The risk-reward profile is compelling, with multiple catalysts on the horizon. For investors seeking multi-bagger potential, 𝗣𝗼𝗏 is a must-watch. It's not just about catching the next wave, it's about owning the beach. If you're looking for a stock that could transform your portfolio, this is one to keep on your radar. Infrastructure is where fortunes are made in every gold rush. The real winners aren't always the ones digging for gold but those providing the tools, technology and support that make the rush possible. 𝗣𝗟𝗏 is the modern equivalent, supplying the digital picks and shovels for the blockchain era. Will you be the one selling picks and shovels, or just chasing the next coin? The choice is yours. In every era of innovation, those who invest in the underlying infrastructure often reap the biggest rewards. 𝗣𝗟𝗏 gives you a front-row seat to both the crypto and AI revolutions. 𝗣𝗟𝗏 could be the cornerstone of a millionaire-making portfolio. With its unique blend of stability, innovation, and explosive growth potential, it stands out in a crowded field. Don't overlook this hidden gem as you build your future. Now, let's shift to a biotech disruptor on the brink of a breakthrough. The next opportunity is in a completely different sector, but with equally transformative potential. If you're ready to diversify and capture the next wave of innovation, you won't want to miss what's coming up. The next stock could change lives and portfolios. Stay with us. Here's the final pick. Our third pick is Praxis Precision Medicines, ticker PRAX, a clinical-stage biotech company that's making waves in the world of neuroscience. Praxis is on a mission to transform the treatment of central nervous system disorders by leveraging the power of precision medicine. In a field where innovation is desperately needed, Praxis stands out as a disruptor, aiming to bring hope to millions of patients who have long been underserved by traditional therapies. Praxis uses cutting-edge genetic insights to develop highly targeted therapies for conditions like epilepsy, depression, and movement disorders. These are massive markets, each with significant unmet medical needs. By focusing on the underlying genetic causes of these disorders, Praxis is able to design drugs that are more effective and have fewer side effects than conventional treatments. This approach not only increases the chances of clinical success but also opens the door to treating rare and difficult-to-manage diseases. Their lead candidate, 𝗗𝗟𝗏𝗧, is specifically designed to target essential tremor, a neurological condition that affects millions of people worldwide. Essential tremor can be debilitating, making everyday tasks like drinking a glass of water or writing a note incredibly challenging. What's truly remarkable is that there have been no new drugs approved for this condition in over 50 years, leaving patients with limited and often ineffective options. Early clinical trial results for 𝗗𝗟𝗏𝗧 have been nothing short of impressive. Patients experienced significant reductions in tremor severity, allowing them to regain independence and improve their quality of life. Even more encouraging, the drug demonstrated a favorable safety profile, with fewer side effects compared to existing treatments. These results have generated considerable excitement among clinicians, patients, and investors alike. The pivotal Phase 3 data for 𝗗𝗟𝗏𝗧 is expected to be released soon, and it could be a true game-changer for both Praxis and the entire field of movement disorder therapeutics. If the results are positive, Praxis could be on the verge of delivering the first new treatment for essential tremor in decades, a milestone that would not only benefit patients, but also position the company as a leader in CNS drug development. Should the Phase 3 data meet or exceed expectations, Praxis will be well positioned to seek FDA approval. Approval would unlock access to a multi-billion-dollar market, as millions of patients and their families are desperate for better solutions. The commercial potential is enormous, and the company could quickly become a household name in neurology. Wall Street is taking notice. Analysts are projecting massive upside for Prax, with some price targets ranging from 3 to 5 times the current share price. This kind of potential return is rare, especially in a sector where a single breakthrough can send a stock soaring overnight. The anticipation around the upcoming data release is building, and savvy investors are watching closely. But Praxis isn't a one-trick pony. The company has built a robust pipeline of drug candidates, each targeting different aspects of central nervous system disorders. This diversification reduces risk and increases the likelihood of long-term success, even if one program encounters setbacks. At the heart of Praxis's innovation is their Cerebrum platform, a proprietary technology that accelerates the discovery and development of new drugs for rare epilepsies and other CNS disorders. By integrating advanced genetics, data analytics, and deep clinical expertise, the Cerebrum platform enables Praxis to identify promising drug targets faster and more efficiently than traditional methods. Of course, investing in clinical-stage biotech is never without risk. Clinical trials can fail, regulatory hurdles can arise, and competition is fierce. However, the potential reward is truly asymmetric. A single successful drug approval can create enormous value for shareholders, far outweighing the risks of early-stage setbacks. For those willing to take the leap, success with Praxis could mean generational wealth. Even a modest investment today could multiply many times over if the company delivers on its promise. This is the kind of opportunity that can change not just portfolios, but lives. Importantly, Praxis is well capitalized, with a strong balance sheet that reduces the risk of shareholder dilution. The company is led by a seasoned management team with a track record of bringing innovative therapies to market. Their expertise and vision inspire confidence that Praxis can navigate the challenges ahead. For high-risk, high-reward investors, Praxis offers a rare shot at participating in breakthrough science and potentially life-changing returns. The combination of a promising lead drug, a diversified pipeline, and a powerful discovery platform makes Praxis a standout in the biotech space. As with any speculative investment, position sizing is crucial. Don't bet the farm, but consider allocating a small portion of your portfolio to Prax. Sometimes it's the smallest bets that deliver the biggest rewards, especially when the odds are in your favor. The window of opportunity is now, before the pivotal Phase 3 data is released. Once the news is out, the market could reprice the stock in a heartbeat, leaving latecomers on the sidelines. Imagine the impact if Praxis succeeds, not just for patients who could see their lives transformed, but for investors who believed early. This is a rare chance to be part of a story that could reshape both medicine and your financial future. This is the kind of innovation that can transform lives and fortunes. It's about more than just numbers on a screen. It's about making a real difference in the world, while also building lasting wealth. Keep Prax on your radar. With a breakthrough potentially just around the corner, this could be one of the most exciting biotech stories of the year. Let's recap your path to $1 million portfolio. It starts with identifying disruptive companies, understanding their catalysts, and acting before the crowd catches on. 3 stocks, 3 powerful catalysts, and 1 clear roadmap to wealth. The choice is yours. Which opportunity will you seize? Final thoughts coming up. Don't miss it. Stay tuned for our final analysis and actionable next steps. Here's how to take action and position yourself for the next big biotech breakthrough. There you have it. Alibaba, 𝗣𝗟𝗓, and Praxis. 3 growth stocks with high potential to buy now. Together, they offer a blend of value, growth, and innovation. Exactly what you need for life-changing wealth. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. For exclusive tips, deep dives, and real-time alerts, join the Stocks Galore Patreon community. Now your turn. Which stock are you most bullish on? Alibaba, 𝗣𝗟𝗓, or Praxis? Drop your pick and your reasoning in the comments. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Don't forget to like, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important financial investing update. Thanks for watching, and I'll see you in the next one.